Hi there. In today's video, we're gonna be doing a fundamental analysis of a company called Evolution, which is a Swedish B2B company that provides live casino and RNG games to land-based casinos and online operators. Now, if you watched my previous video that I released last week, you already know that I have a position in the company. So I might be a little biased towards the company, but I will try my best to evaluate the risks that are involved with investing in Evolution. Now, in the video, we're going to be going over my personal checklist, which now contains about 117 items. And we will end the video by giving the company a total score. Now, don't worry, I'm not going to go over all the items in this video. It would make it probably a couple of hours and nobody would watch it. But I will go over some highlights for you, which I think are interesting regarding the business. And after watching this video, if you're interested in gaining more knowledge about Evolution, I would recommend first of all reading their 10K, their 10Q, and going over their earnings transcripts. I would also recommend reading a write-up from Altafox Capital and from the Wolf of Haircourt Street, which is the main write-up that I use in this video, and it's a really good and detailed write-up. And the write-up from Wolf of Haircourt Street is only a week old or so it has the latest information about the company. You also have good write-ups on valueinvestorsclub.com and on seekingalpha.com, along with some material about the company on YouTube. Now let's dig right into the checklist, and the first things that I check with a company is their business model, how they make money, am I able to understand how they operate, and what are their primary sources of revenue. So the core of the business is their live casino offerings, where they recreate the real casino experience through high quality video streaming, and live casino includes table games like blackjack, roulette, baccarat, and poker. They also have Monopoly Live and Dreamcatcher. I would recommend checking out Monopoly Live on YouTube. It looks a little bit weird, but people seem to like it. The company also provides RNG slots, both classic and modern video slots, along with their game shows offerings. The company's primary source of revenue is commission fees and dedicated table fees through their live and RNG casino offerings. And of that, the majority of the company's revenue comes from their commission fees, where they take 10% of the operator's winning generated from their casino offerings. And as we can see here, the live casino makes up 84% of revenue and is growing at a staggering pace of 34% year over year as of Q2 of 2023. However, the RNG is not as strong and only makes up 16% of revenue, and they've gotten most of that revenue through acquisition, and it is actually declining 4% year over year in Q2 of 2023, like we can see here. But management has been pretty vocal about their goal for the RNG segment, which is a double-digit growth. At the moment, it seems a little bit optimistic, but we'll see. The company has been able to execute really well on their plans in the past. So next up, we're going to talk a little bit about the industry and the key competing businesses. Now, the global online gambling market is growing really fast and is expected to reach 153 billion by 2030, with a projected compound annual growth rate of 11%. And Evolution Management has been setting the strategic objective of outpacing global market growth in order to increase the gap between them and their competitors. Now, looking at the competition for Evolution, Playtech is a public company, so we can actually check their financials. We can see that their return on invested capital is fairly low, especially if you compare it to Evolution. They have a decent growth in revenue for the last 10 years. Free cash flow pretty low at only 10%. So I think it's safe to say, at least when it comes to Playtech, that Evolution is a much better company. Now they have some other competitors, like for example Vivo Gaming, which received the prestigious EGR Live Casino of the Year award in 2022, which is a title that Evolution had held for 12 consecutive years, which is a little bit concerning, I'll admit that. And another one of their competitors is Pragmatic Play, which received the EGR Casino Software Supplier Award in 2022. Now, the next thing on the list is, how does the business differentiate itself? Now, like the Wolf of Haircut Street says here, Evolution is a comprehensive live casino solution. Their solution covers all aspects which are required by gaming operators, including game presenters, streaming, production, supervision, and customer services. They also have the Mission Control Room, which is central to Evolution's operations, where they focus on operational excellence, system availability, security, and regulatory compliance, which is super important when you're dealing with online gambling. Now, Evolution is what you would call a one-stop shop where they provide operators with a complete live casino solution and users with a unique gaming experience. They have been integrating Evolution's core business with the companies that they have been acquiring, like NetEnt, Red Tiger, Big Time Gaming, Azuki, and No Limit City brand games. And we can see the benefits of that to the clients of Evolution explained in this picture here, which is from the company filing. Now, a problem with the company that I saw that the Wolf of Haircut Street also mentions, and that you can also see in the Value Investors Club write-ups, is that the company is depending on very few customers. And as we can see here, the company's 1 to 5 biggest customers made up about 30% of their revenue in 2022, with the top one customer making up about 14%. Now, this is a little bit risky in my opinion. If, for example, the biggest customer were to move over to a competitor, that would significantly affect the revenue of Evolution. Now, another big risk with Evolution is, of course, regulation. That is always one of the biggest risks when dealing with a company that's in the gambling space. But regulation can also be considered to be somewhat of a moat because regulations are pretty strict, especially in Europe. And if you want to get a license there, it's not easy for new players to enter the market. Now, the Wolf of Haircut Street mentions here that the introduction of new online gaming regulations in various European countries, where you may need specific licenses, maybe for each country, would stop the company from using the single EU license and would increase their administration expenses. Now, when I'm researching a company, I always try to find out if there is a short thesis out there. I did find this one. It is a little bit old, since January 29 of 2022. Actually, after reading the article, I wasn't worried because there doesn't seem to be much merit to what the short seller is saying. So he says here that the Evolution stock is overvalued at 40 times full year 2021 EBIT, due to the fact that 62% of the overall revenue of the company is derived from unregulated markets, which could be at risk due to future regulatory clampdowns in areas including Asia and the US. Now, the short thesis is really long, about 100 pages or so, so obviously I didn't read all of it, but I watched a video on YouTube about it where they were discussing what the details of the short thesis was. And the guys that were doing the YouTube video did agree with me that the short thesis wasn't really based on facts that you could prove. So the next thing that we're going to be taking a look at is where the company is reinvesting their capital. Now, they have been acquiring companies, like I mentioned earlier, to integrate their core platform and make a one-stop shop for their clients. Now, they made quite a few big acquisitions in the last 3 years, buying NetEnt for 1.8 billion, Big Time Gaming for 450 million, and No Limit City for 340 million. And they also spent a lot of money on R&D in developing their games to make their platforms better for their clients. Now, the next thing we're going to take a look at is what industry metrics measure business performance. Now, these are actually some metrics that the company's management has put up for themselves. And as we can see here, their medium to long-term objectives are to distribute a minimum dividend of 50% of net profit over time, which they were able to manage in 2022, distributing approximately 50.6%. Now, personally, I don't like that objective with their really high returns on capital. I would prefer that the company would just reinvest the money within the company itself, but that's just my personal opinion. Now, the next objective is concerning growth, which we mentioned earlier is their objective to increase the gap with their competitors and grow faster than the global online market, which they have achieved with over 36% growth compared to about 13% for the total online casino market. Next up, we're going to go through their financial, which, spoiler alert, are really good. Now, Evolution has a spectacular free cash flow growth rate, which is one of the most important metrics to have. It doesn't matter if you look at it from a 1 year, 3 year, 5 year, or 10 year standpoint. The company is actually not that expensive if you measure it using enterprise value to free cash flow or price to free cash flow. Now, the return on invested capital is very strong and getting stronger along with the return on capital employed. The company has really high return on equity and strong margins, with operating margin being 62% for 2023. Now, one of my concerns with the company is that the operating margin might be a little too high to be sustainable, especially if they keep on struggling with their RNG games. Now, the company has a strong free cash flow margin, which seems to be growing. Their current ratio is strong. They have almost no debt, but they have been diluting shareholders a little bit with the acquisitions they've been doing for the last couple of years. But in defense of management, the company's multiples have been pretty high for the last couple of years as well. So it's always a question, if you want to use stock as currency, it's at least good to use it when the company is trading at a really high level. Here we can see an overview of the company's performance for the last 10 years, and these are just really beautiful numbers, with the growth rate per share for revenue being 48% for the last 10 years and 50% for the last 5 years. EPS growth really strong, same with free cash flow like we saw earlier, book value. So basically the company ticks all the boxes when it comes to the financials. Now, when it comes to evaluating the company's competitive advantages or their moat, I don't think there's a doubt in my mind that the company has a really wide moat. They do have intellectual property through their exclusive portfolio of proprietary games, where the casino operators have to license Evolution's live casino solutions to be able to offer these games, and that creates a barrier to entry. They also have the advantage of scale, which is unlike land-based casinos, which are limited by physical space, and the company can accommodate virtually unlimited number of players at the casino tables without putting in more physical infrastructure, like expanding the casino floor and getting more dealers. Now, since 2014, Evolution has been able to more than double revenue per live table from 404K up to 914K. The company's moat is also stronger because of the switching cost their clients have to pay if they want to switch to one of their competitors, because there is a substantial one-off setup fee of 50,000 euros for dedicated tables, which represents significant upfront investment for casino operators. And also, when players are happy with the specific games that Evolution is creating, it's hard for the casinos to switch from Evolution where they can't offer the same games. I also like to show you this table from livecasinos.com, which the Wolf of Harcourt Street shows in his write-up, which is the top live dealer software providers by games. And we can see that Evolution is a dominating player in the space here, having the best blackjack software globally, best baccarat software, best roulette software, and best game show software. And we can also see in the UK, Esuki is a company owned by Evolution, so they are pretty strong everywhere except maybe in the US, where they're hopefully gaining a more market share in the coming years. And some comments from industry experts. This is coming from the president at Casino Games Corporation, where he says that Evolution is widely considered the best in the business for live dealer products. They have the infrastructure and experience. Live dealer has many advantages, and I think it will be quite big in the US market, which is very good for the company. And having robust infrastructure allows them to scale and manage the growth much better than their competitors. The next thing that we're going to look at is the management of the company. The company is not currently led by their founder, which is something that I really like when investing in companies. But the leadership team holds a significant position in the company and has skin in the game, which is always good to see. Martin Carlesund, the CEO, has about 583 million invested in the company. Here we can see Fredrik Osterberg, a co-founder, with 51 million. The CFO, Jacob Kaplan, 61 million. million, and Todd Hausholter, which is the Chief Product Officer, has 99 million. Sebastian Johannisson, I don't know how to pronounce that. He is the Chief Strategy Officer and has almost a billion euros invested in the company. So that's all positive news for investors to see that management is also invested along with us. But when trying to gauge at management integrity and to kind of see the culture of the company, I go to a website called glassdoor.com. Now, that is a website that rates the company overall and the CEO. Unfortunately, the reviews for Evolution are not that good. They only get 3.2 stars, where 54% would recommend it to a friend and only 52% approve of the CEO. And here's a fairly new review from October 10 of 2023, where an employee of the company calls Evolution the Amazon of casinos, which I don't think he means in a positive way. So we will mark the Glassdoor item on our checklist as read and continue on down the list, where the next thing that we're going to be taking a look at is goodwill to assets. Now, the goodwill to assets for the company is 0.52, which tells us that a staggering amount of their assets is goodwill. A little bit too much, in my opinion, which is due to all of their acquisitions for the last couple of years. Now, all of that goodwill might affect the company's earnings in a negative way for the coming years, because when goodwill gets impaired, it actually affects the earnings, not the actual cash flow of the company. But that could lead to the company paying a lower dividend due to their financial target of paying 50% of net profits as a dividend. Now, another thing that I like to take a look at when researching a company, if any gurus own it or not. And the only guru that I could find is Chris Mayer, which wrote the book 100 Bagger, which is a really good book. He has his portfolio of about 10 companies, I believe. And Chris Mayer is an investor that I look up to and respect really much. So I'm really pleased to see him as an investor in the company. Now, to wrap up this video, we're going to go over a couple of things regarding the valuation of the company. Now, we already established that the company has been diluting shareholders with their acquisitions, and I also like to look at the cash conversion of the company or their quality of earnings. On the quality of earnings, the company actually failed. I won't go into that deeper, but the way to measure quality of earnings is to see if the operating cash flow numbers are higher than the EBITDA. And in the last 5 years, operating cash flow is always lower than EBITDA, which does mean that the company doesn't have the cash conversion that we want to see. Now, next up, we have the Buffett test of $1 of value. That is basically we're seeing if $1 of retained earnings created at least $1 of market value for the company. Now, if you go to the balance sheet, you can see that the company retained just over $1 billion of earnings for the last 5 years, while gaining about $14 billion in market cap, which means that for every dollar retained by the company, they gain $14, which is pretty good. Now, the Francois Rochon test of 50% in 5 years is actually something that I learned by reading his giverny letters to shareholders, which I would recommend to everybody. Now, Francois uses earnings per share. I like to use free cash flow per share, and the company is producing about $4.40 in free cash flow per share. Now, if they can grow it for the next 5 years by 15%, it means that they'll be making $8.85 in 5 years in free cash flow. Now, if we put a multiple on that $8.85 of about 25, which is pretty low for the company. They've actually had the average free cash flow multiple of about 35 for the last 5 years. Then we could see that the company would be worth $220 in 5 years. Now we want to divide that number by 2, just so that the current price is at least lower than this number here. And as we can see here, Evolution is trading at $93, which gives us a good margin of safety of what we think the future value of the company will be in 5 years. So I'd like to briefly mention this ratio here, which I came up with by myself. You are probably familiar with the ratio from Peter Lynch called price to earnings to growth. Now, this one is price to free cash flow to growth, which basically compares the price to free cash flow to the free cash flow growth of the company. So, like Peter Lynch's PEG, we want to have this number here as low as possible compared to the 1 year free cash flow growth rate. I also like to compare it to the 3 and 5 year free cash flow growth rate. And as we can see in the case of Evolution, this number here is much lower than these three, which is pretty good. Now, the last valuation method that I'm going to be using in this video is the old DCF, where I will put in a discount rate of 10%. Now, the growth rate I'll put in is 20%, which is pretty high for the next 10 years, I'll admit that. But then the growth rate for the terminal stage is 4%, which gives us a margin of safety of 38% and a fair value for the company of 151. Now, putting this number down to 15%, we can see that we still have a margin of safety and that the market is actually projecting that the company is going to grow at a 13% growth rate for the next 10 years, which in my opinion could be a little low. Now, the last two questions that I like to ask myself before giving the company a total score is, first off, is the company a cinch? Which in my opinion, the answer is yes. And would you put 20% of your portfolio into the company? That is to say, if I could only invest in 5 companies, and the answer to that is yes as well. That gives the company a total score of 92, which is pretty high. Now, I already have a position in the company and I might be adding to my stake. With that being said, I hope you liked the analysis of Evolution. Make sure to like the video and subscribe to the channel if you haven't already. Thanks for watching, and I will catch you on the next one.